Good afternoon, everyone, and welcome to the Ray White Commercial Between the Lines live webinar. So glad that you can join us today, because today we're talking about all things childcare, certainly an asset class that a lot of people are talking about, and I get asked about it an awful lot. So let's get stuck in and introduce our panellists for today. It's a big lineup, so we'll hear from lots of different perspectives. So first up, we've got Sethi, who is the Associate Director at Ray White Commercial Western Sydney. We've got Ben Kirby. Ben is the Executive Director at Ray White Capital. And we also have Adrian Fonseca, and he is the Managing Director of Oxanda Education. So thank you guys. Thanks for coming.
Thank you.
So certainly an asset class that a lot of people are talking about. It's been one of the kind of more busy asset classes, I suppose, particularly over the last, say, 5 years. I might just start with you, Adrian. We appreciate your time coming. And can you tell us a little bit about Oxanda and what you guys do?
Thank you. We are a private medium-sized operator. We are operating in 3 states, New South Wales, Victoria and Queensland. We've got a head office team based in the Gold Coast, and we've also got an operations team in Sydney and Melbourne as well. So our business model is fundamentally growth corridors in Sydney and equivalents in sort of Melbourne and southeast Queensland. So in Sydney, Western Sydney, in Melbourne, sort of the southeastern corridor and sort of west out to Geelong, and in southeast Queensland, anything from sort of Gold Coast up to sort of Noosa, and then predominantly in that sort of Ipswich corridor. I mean, we focus on growth corridors because they're sort of, you've got a high proportion of 0 to 6 children, young families, dual incomes, and that's really your demand piece. I think from an operational perspective, you've then got a nice combination where you've got the demand side, but also the childcare educator side or the employment side, which is the key piece of the business. So, look, I think it's also the case, and John, Ben will talk about this as well, is that land is cheaper in these areas, and so it's, the cost input side is more affordable, and then you can sort of adjust and tailor your fee. But definitely the demand side of the equation is just more conducive to business operating conditions in those areas.
Yeah, that's for sure. So population obviously particularly strong across the country. Most recently, in the last couple of years, that immigration tap's certainly been turned back on, and those areas that you mentioned are definitely going to see be the recipient of those kind of largest amounts of population. So it makes sense. But we might start there with you, Jay, talking about the investment market, if you like. It's a market that's been, childcare's been an asset class for quite some time. It's probably grown in popularity, it's been around for a long time,
That's
but
right.
10 years it's been quite active, been writing about it for that amount of time, but it probably in the last 5 years during COVID really kind of piqued up people's interests. Can you tell us a little bit about where we're at for the asset in terms of investment demand, and just tell us about what's happening in childcare?
Yeah, I think it's quite interesting. I mean, obviously, as you said, that childcare has been very popular for many years, but I think it has gotten a lot of attention in the media from the last, 4 to 5 years. And one of the major reasons is government subsidies. Like we have seen, government has committed to 4.6 billion nearly from this July, which has kind of intrigued a lot of people to think it's heavily supported by government. Let's have a look at this. And during COVID, what we have seen that was one of the safest investment where you would put your money in, and it's still operating, as well as retail, convenience, and fast food. So people felt a bit, that security from this asset class, and therefore they were paying premium prices for those, even though, the market was uncertain, nobody knew what was going on. So I think government subsidy is definitely one of the biggest factor recently what we have seen, which is driving people to go towards childcare compared to any other asset classes. And in terms of, that the prices, what we have seen is still quite stable. We have changed a little bit of landscape in this as a class compared to COVID and now. I think COVID, obviously, we saw the interest rates, 2% you could borrow money at 2 or 3.
Yes.
Compared to now, it's like double.
Yes.
However, it's very interesting to see that we haven't seen the change in the adjust of the pricing of the cap rates.
Yes.
We were seeing sub 5% or even sub 4% in certain investments, depending on the
yields.
Price point, condition of the property, and the covenant. And everybody was kind of speculating. Interest rate is 7% now to borrow some commercial asset, circa, and people are still paying 5.5%.
Yes.
So whether the market is sort of why it hasn't changed, what we have observed that people who are buying this asset class, yes, they're looking for a better return, but I think there's a stronger desire of having a security.
Yes.
And I think it comes down to 3S, what we look at it like: security, stability, and also subsidy.
Yeah.
That's what I tell people as well when people are trying to, negotiate well with us on price, and we pitch it to them and saying, look, there's nothing else. You can buy something which will give you a long-term lease and no headaches compared to you buy something. Yes, you will get 6.5.
Yes.
But you might be getting called every month. There's a plumbing issue, there's an electrician issue,
Yes.
childcare. These guys operators are very hands-on in a way that they don't want landlord to take a position that, we want you to fix it. So that's fine. We'll do a triple net lease. Let us fix it.
Yeah.
So in that way, it gives a lot of confidence to these investors. We can be so busy in doing our business and do what we need to do. We just pick up a check every month.
Yeah. And they're long-term leases too.
Absolutely,
So like we sometimes, with some of these alternative asset classes with these long-term leases, we call them set and forget sometimes. So it's you've got the confidence that you've got a good quality tenant
Yes.
in there. They're going to be there for a prolonged period of time, so you just don't need to worry.
Yeah.
So that's why we haven't seen that change in cap rate representative of that change in financing
Yeah.
cost quite to the same extent.
There's a bit of, obviously, as you said, there's a bit of change. Obviously, it's not still, I think I'm seeing it sub 5%. The price point is very important as well. If you see a childcare selling for about sub $5 million, there's a bigger buyer pool who are willing to invest in that sector compared to there's a 7 or 8 million. When it starts at 7, 8, 10, people are like, we want better return, or let's look at other options where we can make money. So I think price point is very important. And also it's important whether it's a brand new asset or a 20-year-old asset. Something is brand new. You can claim a lot of depreciation for the first 5 years, which
Of
can
course.
offset a lot of your, your income and that, so your taxes, and you're kind of taking all the income in your pocket. And obviously the last thing is the covenant. Who is your tenant? You want to get the confidence as who's operating the business and how they're performing. So location is the key thing.
Back to Adrian's point about the growth corridors.
That's right. At the growth corridors, you need to know that what kind of families are living in the area, and or what sort of income in those areas as well. And if there's a growth area, back to your point, that definitely there's going to be demand for childcare services.
Yeah.
Young
But
families.
Jay's hit on something interesting there, because when you talk about cap rates, only going up by say 25 or 50 points when interest rates have gone up 3.5%, then for the first time in a property-related asset for a very long time, equity is cheaper than debt. Yeah.
Yeah.
And
Yeah,
when equity is cheaper than debt, you've got an interesting conundrum, which kind of goes back then to say, is this actually really equity? Because you've got these 15-year long-term leases that go up by CPI every year, so they're almost like inflation-linked bonds, aren't they?
Yeah.
And that's why they're so attractive.
Yeah.
So tell us, Ben, we talked about financing briefly. Where are you? So what kind of deals coming past your table being in that kind of capital space?
Look, we for those on the webinar that don't know, look, we're a provider of equity and debt capital, so we're kind of agnostic, where we sit in terms of capital. The business has deployed equity into a number of childcare developments in Queensland and New South Wales, which, fortunately for us, I guess, was pre-COVID. Look, we've seen a number of deals come across our desk. I think the biggest thematic in the market at the moment is making sure you're getting your feasibility right in terms of construction. Rents have obviously increased off the back of higher construction prices and a lack of supply. The other thing too is that because you're able to get a childcare DA in like residential zonings, while planning is difficult in some areas, there's a lot of available supply that could be delivered if it could be financed. Given that you can get a DA for a childcare centre in predominantly residential streets. Look, in terms of the capital piece, development in the industry generally is still well supported by the banks from what we've seen. Look, as Adrian touched on and Jai as well, look, the cost of equity has certainly gone up in terms of that development piece. Obviously, with interest rates going up, money is seeking a higher return. So, look, not that it's harder, but I guess capital is probably a bit more selective in the deals that it wants to take on at the moment. Then in the back end of that, though, look, there's no shortage of buyers, for the completed product once you actually, go through the development phase, get an OC, get the tenant occupied.
Yeah.
The market on the back end is still enormous, and certainly in the deals that we've done, we've sold a number of them, and they've been very well bid, throughout that process at pretty tight cap rates.
And with the financing, and maybe you can answer this, Jay, is about the LVR. So if you're an investor looking to buy one of these, what sort of borrowing ratios are there?
Well, I think,
Was that a Ben question?
yeah, I think probably Ben, it's probably will be answered in detail, but what we get from the buyers or the investor who are looking at it used to be, depending on bank who you're going with, used to be even the LVR could be 60-65%, but now it's coming back to 50%. That kind of raises a big question. And a lot of investors, if they're buying a product for $5 million, do they really want to spend $2.5 million? Therefore, it comes back to that point. As the price ticket goes bigger and bigger, you need to put more money in there.
Yes.
Yeah. If you're willing to put $3.5 million for a $7 million asset, then you raise a question that what are the other options available to invest?
Yeah.
When it's something small, it's fine. $3 or $4 million end product and $2 million you're putting in there, that's fine. You get a good return on your capital as well. So I think that's what I'm seeing. A lot of people are saying to us that's 50% we have to put it in. And plus it's not favourable for a lot of banks as well. That's also, we hear sometime.
Yeah, look, banks are supportive, and also obviously the non-bank market. But given there's relatively tight margins in childcare development, often non-bank rates aren't conducive to a profitable development. But the banks are supportive, and look, in our experience, people are still able to achieve sort of a 55, maybe a 57 LVR on completion val. The other piece of that too is obviously that. As the market has turned, valuers, I guess, have become more bearish, and so given that your financing is based on an on completion valuation, at a proposed cap rate, that leverage has come back a little bit, depending on where you can kind of get the val to stack up.
Yeah.
Look, in our experience, the metro areas are holding up, better for valuations than say regional areas. Which is always the way when the market turns.
Yeah.
So look, finance is still available, and you're still getting over sort of 50% leverage. But as with all things at the moment, everyone's a little bit more cautious. Things take a bit longer.
Yeah.
Labour and all that sort of issue.
That's been the nature of this year.
Yeah, it has.
It has sort of. Post-COVID. I do want to go back to talking about the development site stuff, because I know that there's been an awful lot of development site stock on the market for childcare assets, and probably more sales this year than there has been in the kind of previous years in terms of development site stock. What can you tell us about that?
Yeah, I think that sector is more kind of interesting to look at development compared to the investment sector. As Ben was saying, in terms of it's quite easy sometimes. It can be if it's just an R2 zone and you can put a DA there. It has its pros and cons as well, right? Like you look at it and anybody can put a DA on R2 if it's a substantial land holding and if it ticks all the boxes. And on the next street, somebody else is putting it as well because they want to maximize the value. So it has been a major change we have seen in the last 2 years. Last 2 years ago, we were like selling development sites quite at a premium prices because it was very hard to do a DA, even though now. However, we started to see that people saw the prices we were trying to achieve, they were quite impressive, and people were like, you know what, I've got a house which is 1,000 meters or 1,500, I might as well go to DA.
Yeah.
So we started to see our friends and family and cousins, everybody started doing childcare DAs because everybody wanted to be, do development. So, and we saw a massive shift. Last year, it was still great as well, but now we start to see that it's kind of not as most favorable anymore what it used to be. It's still favorable, but it all comes down to the location.
Yeah.
People are becoming more smarter in a way. They're doing the research. If there's a site available for sale, what's the demand and supply?
Yeah.
How's the occupancy look like in the area? If across the road somebody is not performing well, if it's not at 100% or if it's at 70, I'm not going to go and touch it.
Yeah.
It doesn't make sense. So I think people need to be very careful of, when they're doing DA for any childcare at the moment, they need to do proper research or maybe hire someone, a consultant who can do a proper research for them. There are some companies out there, or call us, we have to look into for them. So I think that sort of a thing we have seen, but still there's a lot of stock coming in the market for development. We used to see last year was 1 or 2 sites available at a given time. Now there's about 5 or 7. They're still selling. It's not the good thing. They're still like achieving price. But it's not as premium what it used to be. And there are 2 major reasons. One is obviously the construction cost has gone up, and the second is the interest rates has gone up as well.
Yeah.
So in a nutshell, at the development sector, what I think is just people need to be careful about the location. The safest is to go in growth areas, where there's young families moving there because they can't afford to buy a house in metro. They rather go to areas like, anywhere in growth areas, and they can see that, they can build a nice house there, and there's young families, they can work as well, and therefore there's a demand for childcare in those areas. It's kind of the safest.
So just on Adrian, to talk about this whole population piece, that's obviously where he's looking for his business model, where he goes forward. But as an occupier, what is it other than kind of location that you look for in terms of an asset, both either to lease or buy?
Yeah, great question. So to Jay's kind of R2 point, just to go through the zoning for the listeners, all residential zonings permit childcare, all commercial zonings, and even light industrial. Yeah, so it's really only sort of heavy industrial. So in the example of sort of Sydney, you might see childcare centres in, say, Artarmon, for instance, because it's a light industrial zoning. Historically, and it's still the case, but it was all the business model was always based on being adjacent or nearby a primary school, and that's how ABC Learning Centres developed their business, and it was a very successful business, and they've obviously morphed into Good Start. For us, what we saw was a shift whereby we think now, I should say, that the better location is in a commercial precinct, adjacent amenity like a Woolworths or a Coles or even QSR. So you'll see lots of developments where you might have a McDonald's and then a childcare centre. So I think that QSR merging with childcare works very well. And I think what operators like us have worked out is that being proximate a childcare centre is fantastic, but also being proximate amenity like a supermarket or a gym or a neighbourhood precinct is also very good. I think the other thing is that it's definitely harder to get approval in a residential zoning these days because every family wants childcare centres, but not many families want to live next to a childcare centre.
And Jay's family and cousins and everything have already kind of
they've obviously covered the market, so we have to go into the commercial areas. But we found it fantastic, and we've worked with a lot of developers. And we work very, very well with RW Capital in finding a precinct that's got a lot of different uses, and that sort of multiple uses or essential needs, as we call it, sort of post-COVID, is fantastic. So you drop off your kids at the childcare centre, grab some groceries, go to the gym, get a coffee, maybe do some Pilates as well, right? So it's all sort of part of our
all about convenience,
It's
right?
all about convenience. It's all part of our ecosystem, and I think as individuals, we don't mind a 5 or 10 minute drive, rather than just sit around in the house. Growth corridors we talked about. That's definitely where the demand side is. And that's where we like to be, and we flourish in those areas. The reality is in, closer to central areas, higher income areas, there are less families just based on the obvious aspects of the demographics. So the demand side for us is very strong, and it's also strong because of what Jay and Ben were saying, is that the supply side is actually on delivered centres is less, because there's sites that are being sold which, for various reasons, but often it's because the feasibility doesn't actually stack up anymore, And so when that's happening, and someone's got to find a different use, that supply that you were predicting to come into the market is obviously, stymieing what was otherwise expected. We've got 8,500 childcare centres nationally, right?
Yeah.
And we've got a 2% birth rate, and we've got a 2% migration rate typically, and now that it's back open. So you're looking at 4% increase across the nation in terms of what we need to absorb the increased demand. And that hasn't been coming on. So for vendors of completed assets, they're in hot demand because there's actually not that many around, right? And they haven't been coming on. We've got 6 centres opening in 24, in the first half of 24, that were all scheduled to open in first quarter of 23, right? and that sort of 12-month delay is really what we're finding, which is why demand is not an issue at the moment. And because we're regulated in terms of ratios, unless you have the staff, you can't actually take the occupancy. And staffing nationally, and I know this is applicable in other sectors, is our number one issue.
That was my question going to be. Is there a size of centre that is more favourable? However, it's depending on location, but also the staffing piece. The staffing piece is obviously critical at the moment. So it's hard to...
Yeah, well, I think different people have different views around their model, but we like 100 places, plus or minus. So at 100 places, you're really offering 20 in each age group that's between 0 and 5, you can obviously do 120 or 90, but 100's our sweet spot.
Yeah, and I think you're right that it's the preference of every operator. I've seen operators that love to be in 50 to 60 places because they believe if we have 100 places, it might not get full, but we are paying rent for 100 places. We might as well stick to 60 and make it full and make it a successful business.
That brings me to the leasing. Do you want to talk briefly on what's happening in that kind of leasing space? Because like you said, the built product is, king.
Yeah, I think I would say leasing probably one of the most favourable in terms of the high demand compared to investment and development sides, which makes sense as well. You would agree to that, because leasing is something when you're trying to open a new business and you look at your capital, that's probably the least amount of capital you need to deploy to set up a centre. Could be 300, it could be 400, depending on everybody's on fit out and bank guarantee. Compared to if you're going and buying a site and constructing it, you will be sitting on $5 to $7 million. So the operator's argument to me is, Jay, we have a leasing model. We don't look at real estate. We can buy real estate later on. We want to, have lined up 5 or 10, 20 centres, which makes completely sense. So therefore, we are seeing a leasing demand is very strong. So I think we have done probably 10 or 12 leasing deals this year, and then we even didn't have to go to market, and we have a strong database, and we put it out there, and people are happy to come to terms, and what the landlord wants, it's in their favour. Even the centre is not built yet, so I think people understand that, and because the supply from DAs and the construction, not a lot of projects are coming on the ground, and therefore the leasing works really well, which kind of works perfect with the landlord as well, because sometimes there's a bank requirement that you need to have a pre-commitment. And the second thing is it gives a comfort to a landlord that, I'm building this product, I've got a tenant in line in place, I've got my funding, as soon as it's up and running, I'm going to have my income coming in. So I think definitely leasing, it's very strong. Anybody who's building at the moment, I don't think so they will have any issues finding a tenant, but you just got to make sure there's not oversupply in the area.
Of course. I think we're nearly already running out of time. So a couple of things I still want to touch on, though, is the issue of the subsidies. So obviously, like you said, Jay, that's an attractive investment opportunity for a lot of people because they see it as government-backed. Do you have any opinions on where that's at? I know there's some investigations in what that looks like going forward. Does anyone have an opinion about what's happening with subsidies?
Sure, I'll have a go. Well, I mean...
The 2-minute answer.
I'll give you a 1-minute answer, right? Look, there's bipartisan support for the sector. That's a very strong starting point, right? And the subsidy will always increase now by CPI at least, right? I think there's obviously concern at the government and the ACCC sector when they increase the subsidy by CPI and then fees are increasing at more than CPI, and that obviously creates a connotation that sort of, operators are rapacious. But I think what has to be remembered is you have to look at the sort of the fees over the last 3 to 4 years, right? A lot of it, we couldn't increase fees during COVID, So a lot of it is kind of catch up, and a lot of it is a reflection of the fact that, there's an award which increases wages, rent goes up by CPI every year, and then all of the operating expenses, especially in the energy sector, on the energy side, have increased by more than inflation. So I think that from an investor perspective, and an operator perspective, they should be comfortable that the subsidies will continue. I don't see any abatement in that area. We just need to address, I think, some of the supply issues in terms of centres and the staffing side.
All right, I might just try to wrap up here with getting all of you have an opinion, start thinking about it now on what do we think the childcare sector is going to look like in the next little while, in the next over between now and the end of next year? Is there going to be any major changes? What's happening in that space? Anything new? What we didn't have a chance to talk about, and if you want to weave this in, is metro versus regional. That's another thing as well. So, what's your outlook on the sector?
Yeah, I think outlook of the sector is, I see, Australia as a growing country, and then we are seeing a lot of migration as well. Therefore, there's going to be a young population here. There's a massive demand for childcare needs here. And it plays a vital role in Australia socially and economically, so we don't see any issues moving forward. However, investment side and leasing side will be strong because of the 3S, security, stability and subsidies, and leasing side because the capital, you don't need a lot of capital to set up a business. However, the construction side, which brings to the development side, I think we might see a bit of adjustment, which we have already seen that. The prices have definitely changed, and people have to be careful about where they're putting the DA. They have to do the research. That's what my take on it in terms of investment sides and leasing.
Yeah, awesome. Ben?
Look, to touch on your metro and regional question, I think, look, given what Adrian touched on with immigration, that's always traditionally gone to Brisbane, Melbourne, Sydney.
Yeah.
And I think that's going to remain the case. So in terms of metro and regional, I think, the capital...
nice to our WA listeners.
I know, and Perth as well. Look, I think a lot of the capital and obviously the demand is going to remain in metro areas. And then, look, in terms of the sector generally, I think supply of new product is going to remain subdued just because of the continuing constraints in construction. Everyone sort of has a different view on construction and whether we're coming out of the period we've been through, whether we're not. And look, I think our experience is that it's going to remain tough for at least the next 12 months, which is obviously going to dampen supply. And I think, as Adrian touched on, look, if you've got a site that's well located that, can be financed by a bank that can secure an AFL, I think, that's obviously a good position to be in. So I think there'll be some challenges, but it's going to remain an in-demand sector for, capital and property.
Okay. Large regional, I think, is great.
I agree.
Talking, Newcastle, Central Coast, Geelong, very good. Especially as families move out to these areas. They're ecosystems in themselves. So we love Newcastle, Geelong, these areas as a location. On the occupier side or operator side, conditions are good. Hopefully with skilled migrants coming in to this country over the next 24 months, that labour side will rebalance, and my expectation is it is, and will do. On the investment side, I would say the interest rates hopefully do stabilise and abate, but I think investors should realise that if they can fund the upfront piece, the rent will increase by inflation, right? Yeah. So the next year, the rent will be up 6 or 7% higher, right? So the interest rates actually has a positive effect on your rental, right? So I think conditions are good for investors as well. So, and, completed product is king.
Yeah, absolutely.
Awesome. Thanks, guys. This has been super interesting. I'm sure that all of our audiences loved talking about childcare and understanding a little bit more. But thanks again to Jay, to Ben, and to Adrian. And if you guys need anything, Ray White Commercial Western Sydney, RW Capital, Oxanda. Not sure if you've got any spaces available, but thanks so much for joining us today.
Staff issues. As you just mentioned, staff issues. So
staff issues, you need a job. Okay. So thank you everyone for joining us. It was another great Between the Lines live event. Something really exciting to announce today as well is that we have, from straight away, you can get all of our old webinars now in podcast form on Spotify. To some of those. So that's it for today. Thanks again to everyone. We have our next event on the 8th of November, which is going to be talking about Southeast Queensland industrial market, which is another asset class that everyone's pretty interested in. So thanks so much for joining us again today, and we'll see you next